There is a tool that a 38-year-old trucking company owner in rural Ohio uses to manage $180,000 in annual cargo liability that his standard carrier keeps repricing unpredictably. There's also a tool that a multi-generational manufacturing family in the Mid-Atlantic uses to sit underneath a $500 million balance sheet, coordinating risk across 6 operating entities, 2 real estate portfolios, and a family office. It is the same tool. The structure changes, the discipline changes, the dollar figures change, but the underlying mechanism is identical. That is what this video is about. Before anything else, a disclaimer that is not decorative. This is education. It is not legal advice. It is not tax advice. It is not insurance advice. Captive insurance is one of the most heavily scrutinized structures in the entire tax code. The IRS has placed certain captive arrangements on its listed transactions and dirty dozen lists for years. That scrutiny exists for a reason, and we will get to it. Nothing here should be taken as a recommendation to form a captive, fund a captive, or change how you currently manage risk. If you are seriously exploring this, you need a qualified attorney, an independent actuary, a licensed captive manager, and a CPA who has actually done this work before. What you will get from this video is the framework to understand what those professionals are talking about when you walk into that room. Now, the concept, a captive insurance company, is an insurance company that you create to insure your own risks. That sentence sounds circular because it almost is. The key word is almost. It is not a reserve fund. It is not a rainy day account with a fancier name. It is a licensed, regulated, capitalized insurance entity that must behave exactly like a real insurance company. Because legally and functionally, it is one. It underwrites policies, it prices risk, it collects premiums, it processes claims, it holds reserves, it files with a domicile regulator, it gets audited. The fact that the policyholder and the beneficial owner of the insurer are related does not make it informal, it makes it a captive. Here's why that distinction matters and why it has to be said plainly. Some people have tried to use captives as a mechanism to move money from a profitable operating company into a related entity under the label of insurance premiums, extract the money later, and call it a loss on one end and a tax advantage event on the other. Regulators noticed. Courts noticed. The IRS noticed in detail. The structures that work that way are not the subject of this video. The structures that exist to solve genuine risk problems, that have real claims histories, that are priced by actuaries who do not work for the advisor selling the product. Those are what we are examining. The latter starts with risk, it ends with risk. Everything in between is infrastructure built around risk. So where does the latter actually begin? Most business owners are already on it. They just do not know the name for where they are standing. Level 0 is self-insurance by accident. You carry a $10,000 deductible on your commercial property policy because that cut the premium by $4,200 per year and felt rational in the moment. You hold a cash reserve that you mentally earmark for business disruptions. You have a line of credit that would theoretically absorb a bad quarter. You hope the workers' compensation claim does not come in at the worst possible time. That is a risk financing strategy. An informal, unstructured, undocumented one, but a strategy nonetheless. The gap is not that you have no exposure management. The gap is that it has no governance, no actuarial logic, and no tax-efficient structure wrapping it. A captive becomes rational under specific conditions, and understanding those conditions is more important than understanding the tax mechanics. The first condition is frequency. If you have risks that produce losses consistently, not catastrophically, but consistently, meaning you are paying from pocket often enough that you can build a loss history, that frequency is underwritable. You're not hoping, you're modeling. The second condition is severity volatility. If the swings in your out-of-pocket costs are large enough to distort planning, a captive can smooth that volatility across years, allowing you to reserve in good years and draw in difficult ones. The third condition is the coverage gap. The commercial market has become noticeably harder in specific sectors. Cyber coverage, professional liability for certain industries, environmental tail risk, construction defects. Carriers either exclude these or price them at figures that no longer reflect your specific loss experience. If your company has better loss performance than your industry average, you're subsidizing everyone else's claims through your premium. A captive lets you capture the underwriting profit that should be yours. The fourth condition is control. In a captive, you decide what gets litigated, what gets settled, and at what threshold. You own the claims process. That operational control has real value that does not appear on a premium invoice. None of this works without the non-negotiables, and this is where the serious operators separate from the schemes. Actuarial pricing means an independent credentialed actuary looks at your actual loss data, your industry loss data, and produces a premium that reflects the real cost of the risk being transferred. Not a premium engineered to maximize the deduction, not a number that appeared in a brochure. Risk distribution means the captive is not just insuring you. There is meaningful diversification across policyholders, or risks such that the insurance function is genuine. Claims process means there is a real procedure for filing, adjusting, and resolving claims, one that would hold up to examination by a regulator who has seen the inside of 400 captives. Capitalization means the entity has adequate capital to pay claims. Governance means there is a board, minutes, independence where required, and a paper trail that reflects decisions made for risk reasons, not tax reasons. Documentation means every element of the above exists in writing and would survive a discovery request. Now the fast red flag list, because they are real and they appear with some regularity. If an advisor is showing you a captive primarily through the lens of how much premium you can deduct before they have finished asking about your actual losses, that is a flag. If the policies being written cover risks that have never produced a claim and show no credible pathway to one, that is a flag. If the structure involves premiums flowing out of your operating company and back to you through a chain of related entities in a way that reconstructs to ordinary income after a brief holding period, that is not insurance, that is a circular cash flow with extra steps, and courts have used those exact words to describe it. If your advisor profits from the captive manager they recommended without disclosing that relationship, that is a conflict you deserve to understand before you sign anything. The ladder this video is going to walk through is built on the structures that survive scrutiny, the ones where the claims get paid, the ones where the actuary is not on the same organizational chart as the promoter, the ones where the business owner understood the risk problem first and the structure second. The first rung starts at around $100,000 in retained risk. The top rung holds $500 million in coordinated exposure across a family enterprise. Between those 2 points, the mechanics, the capital, the regulation, the advisors, the failure modes, and the genuine advantages all change in ways that most people have never seen laid out in sequence. That is the ladder, and we are starting at the bottom. You are at the bottom rung. The business generates somewhere between $1 million and $8 million in annual revenue. You have a commercial insurance program that mostly works, but there are gaps, and the gaps have dollar amounts attached to them. Tier 1 is the $100,000 to $1 million exposure range. The risks that start making sense here are specific and boring, that is intentional. Cyber deductibles on your commercial policy that run $25,000 to $50,000 per incident. Warranty obligations on products you manufacture or install, where the carrier will cover catastrophic failures, but the frequency claims come out of your pocket. Key vendor interruption, meaning a single supplier goes dark for 6 weeks and your production line follows, equipment breakdown above your deductible. These are not exotic risks. They are the line items your CFO circles in the loss runs every year and cannot do anything about. At this tier, the structure most commonly considered is a small or micro captive, sometimes called an 831B, captive after the tax code section that governs how it is treated. A qualifying small captive can elect to be taxed only on investment income, not on premium income, provided annual premiums stay below $2.65 million, and the structure meets the distribution requirements. That election is real. It is also the exact provision that drew the IRS's attention because promoters abused it aggressively, which means if you're here legitimately, your documentation needs to be cleaner than average, not because you did anything wrong, but because the paper trail is what separates your structure from the ones that ended in tax court. What does this look like in real dollars? An operating company with a credible cyber exposure might pay $60,000 annually into a captive that underwrites a $500,000 cyber deductible buy-down policy. The actuary models your loss frequency and severity. The captive holds reserves. In year 1, no claims. The $60,000 sits in a conservatively invested reserve account. In year 2, a vendor breach exposes customer data. Your IT forensics and notification costs come in at $87,000. The captive pays the claim. The claims file documents the incident, the response, the cost. That is insurance working the way insurance is supposed to work. The premium was not a deduction dressed up as a risk transfer. It was a correctly priced cost of a risk that materialized. Tier 2 is the $1 million to $5 million exposure range. You are now a small operating company with enough loss history to price genuinely, enough premium volume to justify the overhead of a standalone captive, and enough complexity that the structure starts earning its cost. The annual premium might run $200,000 to $600,000 depending on the risks underwritten. You have a captive manager, you have an independent actuary, you have a domicile, likely Vermont, Tennessee, Delaware, or one of the offshore options like Cayman or Barbados, each with different regulatory postures, capitalization requirements, and reporting obligations. Your captive manager files the annual reports. The domicile regulator examines the company periodically. This is not paperwork as theater. It is the operating condition. Living with your own insurance company changes things at the operational level in ways that are not obvious from the outside. Your claims department, which may be one person or a third-party administrator, processes claims according to a written procedure. That procedure exists in a document. That document was reviewed by insurance counsel. Before the captive was licensed, when a claim comes in, it goes through the same workflow that a commercial carrier would run. The adjusting happens, the reserve is set, the payment is authorized against the policy language. If you decide a claim does not meet the policy terms, you deny it in writing with a rationale. Because your captive has to behave like a real insurer? Not because someone is watching every Tuesday, but because the behavior is the structure. The day you stop treating it like a real insurer is the day the documentation starts lying. At this exposure level, you also start to think about reinsurance for the tail. Your captive can absorb frequency losses, but a single catastrophic claim that wipes the reserve creates a liquidity problem and a capital problem simultaneously. Reinsurance, meaning you purchase coverage from a third-party carrier that sits above a certain loss threshold, protects the captive's balance sheet against severity events your own reserves cannot absorb. The cost is real, the protection is real. This is not a loophole layer. It is the same risk management logic that every commercial insurer uses to protect its own solvency. Tier 3 starts around $5 million in exposure and runs to $10 million and beyond. At this level, standalone single-parent captives remain viable, but group captives and risk pools enter the picture in a meaningful way. A group captive pools premium and risk across multiple unrelated or loosely related companies in similar industries. Each member contributes capital and premium. Each member participates in the underwriting results. The pooling is what creates credible risk distribution for regulatory and legal purposes. It is also what makes actuarial pricing defensible, because the loss database is broader and the independence between policyholders is genuine. Group captives have management structures, governance boards, and underwriting committees. You are not running this alone. You are a member of a risk-sharing organization that has its own operating discipline. The entity mechanics across all three tiers follow the same basic architecture. The operating company pays a premium to the captive. That premium is an ordinary business expense if it meets the arm's length standard and the risk transfer test. The captive holds the premium as a reserve, invests it conservatively, and pays claims from that reserve. What the captive cannot do is pay for things that are not claims under a valid policy. Owner distributions dressed as claims, personal expenses run through the claims process, loans back to the operating company structured as claim payments. These are not aggressive interpretations of gray area. These are the exact scenarios that have produced civil penalties, back taxes, and in some cases referrals that go further than a civil audit. The advisor stack at this range includes a captive manager, an independent actuary, a CPA experienced in captive taxation, insurance counsel who reviewed the policy forms, and in most cases a fronting carrier or reinsurer depending on structure. Competent governance means the board meets. The minutes reflect actual decisions. The actuary was not referred by the person who sold you the captive, and the claims file would survive a regulator walking in with 3 hours and no warning. Rubber stamping looks like annual meetings that last 11 minutes, policies that were never customized to your actual risk profile, and a claims history of exactly 0 across 5 policy years for a business that carries real operational exposure. Domicile choice matters. Vermont is the oldest and most respected U.S. captive domicile. Tennessee and Delaware have competitive newer frameworks. Offshore domiciles offer flexibility but carry additional reporting requirements under PFIC rules and foreign corporation disclosure obligations. The choice should follow your risk profile, your advisor's familiarity with the regulator, and the capitalization requirements you can meet. It should not follow which domicile makes the structure easiest to fund quickly with the least documentation. The failure modes at this tier have lived consequences. A captive that underprices its risk runs out of reserves when claims arrive. The business owner who expected the captive to pay a $400,000 liability claim finds a balance of $180,000 in a coverage dispute. A captive with no credible claims history over multiple years is the single most reliable signal that the regulator and the IRS will identify as a structure that was never operating as insurance. A liquidity mismatch happens when premiums were invested in illiquid instruments and a claim requires cash in 30 days that the portfolio cannot produce in 30 days. Treating the captive's reserve balance like a secondary savings account, borrowing from it informally, directing it to related party transactions, converts a protected structure into an undocumented loan or a taxable distribution, depending on how the examiner characterizes it. The business owner who gets this right at the $100,000 to $10 million level looks like this. They had a real risk problem before they had a captive. They hired an actuary who looked at their loss data and produced a number. They paid the premium. They processed the claims. They filed the annual reports. And when the bad quarter came, the captive paid, the reserve was drawn, and the documentation showed exactly how. That is the bottom half of the ladder. It is not exciting. It is not supposed to be risk financing that works correctly, is almost invisible from the outside. The noise is in the failures. The discipline is in the silence. At $50 million in aggregate risk exposure, the captive stops being a reserve account with a domicile and starts behaving like a financing engine with a balance sheet. Tier 4 runs from $10 million to $50 million in retained risk. Here, the captive is actively layering. You retain the first $5 million, the captive writes the next 15, a reinsurance treaty sits above that. The commercial market, which you still use, covers the catastrophic tail. What changes is your negotiating position. When you walk into a renewal conversation carrying 3 years of credible loss data from a fully documented captive, the commercial insurer is no longer pricing your ignorance. They are pricing your risk. Those are different numbers. The retentions get larger because you can prove you understand your own exposure. The premiums in the layers you cede become competitive because the underwriter can actually read your loss runs instead of estimating them. Tier 5 is the holding company structure. $50 million to $250 million in aggregate exposure. Multiple operating subsidiaries, and a captive that sits beneath a holding entity and writes intercompany policies across the group. Segregated cell and series structures become relevant here. Each operating subsidiary can occupy its own cell with its own premium contribution, its own loss experience, and its own reserve. while the overall capital base pools beneath them. Governance at this tier is not a formality. You have independent directors on the captive board who are not employed by the operating companies. You have an underwriting committee that reviews every policy form before it is issued. You have documented related party transaction policies because every premium paid from a subsidiary to the captive is a related party transaction that has to meet an arm's length standard and survive the transfer pricing analysis. Leadership changes at the operating level do not unwind the captive because the governance was built to outlast any individual. Tier 6 is 250 million to 500 million in aggregate exposure, and the captive at this scale has a multi-line, multi-year structure. Property catastrophe, liability, executive risk, supply chain disruption. The captive's investment policy is a written document reviewed by an investment committee. The reserves are stress tested against adverse loss scenarios, not once at inception but annually, by an actuary who is independent from the captive manager. The reserve is a stabilizer. It absorbs frequency. It provides liquidity when commercial markets harden and pricing spikes. It is not a slush fund, and the documentation makes that distinction explicit on every page. Control at this level means something specific. It means board composition with genuine independence. It means an underwriting committee that has the authority to decline a risk the operating company wants to transfer. It means related party guardrails that are written, enforced, and audited. It means a captive that would make the same decision if the founder were not in the room. Heightened scrutiny follows scale. Economic substance requirements are real. Transfer pricing discipline is not optional. Actuarial rigor is the condition of the structure's legitimacy, not a box to check. Claims need to be credible, which means they need to exist, be properly adjusted, and be paid according to policy terms. The structures that fail at this level are not failed by regulators who are too aggressive. They are failed by governance capture, where the people who run the operating company also control every decision inside the captive by overly aggressive investment policy that converts the reserve into a concentrated equity position, by policy forms written so broadly that every business loss becomes a potential claim, and by the reputational and credit consequences that follow when a structure built on bad architecture finally collapses under examination. A captive at any tier is a real insurance company. It has a regulator, it has policyholders, it has claims obligations. If you treat it like one, it works like one. If you want to follow up on your specific situation, drop a comment with your business type and the top risk you currently carry uninsured. That is the conversation worth having. And one final note, nothing in this video is legal, tax, or insurance advice. These structures require qualified insurance counsel, an independent actuary, and a CPA who has worked in captive taxation. The latter is real, who helps you climb it matters just as much as the rungs.